Hello, everyone. Thank you so much for being here. Good to see you all at DAS 2025. I'm Jack Kubanek. I write the Solana newsletter at Blockworks and also host our podcast. It's all called Lightspeed. You should check us out. There's my shameless plug. It's now out of the way. More importantly, I'm joined today by Anatoly Yakovenko, co-founder of Solana, Kyle Samani, managing partner at Multicoin Capital, two of just the real central people in Solana. Really excited to just dive into it with you guys. We're talking about the future of Solana, so we're going to start with Twitter advertising. No, that's my one joke. We're done. I want to start. We have an institutional audience, and Solana, when it came out, was often pitched totally by you as a decentralized NASDAQ. And more recently, Kyle, you've kind of written the internet capital markets thesis, extending that a little bit. So I just want to start at a basic level to maybe set the table for this conversation. Totally, why issue financial products, market services on blockchain, and why is Solana the right blockchain for that to be done on?
Well, I think I can answer the latter question a lot easier. I think the best place to issue them is going to be the cheapest, fastest blockchain that's globally distributed, because you're reducing costs for the issuer and for everyone that owns those assets and trades them and moves them around. And ultimately, I think the purpose of all these systems like software eating finance is to reduce costs for the users. And I think the reason to do that is eventually because that's just so obvious. Like, I don't know if we're there yet because of there's still a lot of challenges around cost and congestion and a whole bunch of other stuff with MEV. But the technology has proven itself to be, I think, probably better than 95 or 99% of centralized exchanges out there outside of like the major ones in the US.
Better in what way?
In terms of efficiency and pricing for users and cost and speed. Because I think ultimately time is money, right, in finance.
Kyle, is there anything you'd add there as far as your internet capital markets thesis you've put out and why you think that all types of assets should and will be, I guess, tokenized on Solana?
Yeah. There's the trading systems we have today. History is path dependent, and so the systems we have today are, meaning NYSE, NASDAQ, CME being the majors in the US, and then you've got LSE and a whole bunch of others all over the world. All of those systems, their roots can be traced, I think pretty reasonably to say over the last, call it like 50 years or so of kind of like financial market infrastructure evolution. And they are where they are now for some weird reasons, technologically related, politically related. There were some financial crises along the way, whatever, all of those events helped shape the rules and regulations that we have today in mainstream finance, as well as the technologies. And the most obvious and egregious of which is 9 to 5 trading on most major stock exchanges, even though the world obviously runs 24/7. And so what we have with crypto is like just a first principles refresh to like capitalism and just finance. And in its most pure and unregulated form, you just get kind of meme coins and a bunch of other like things that look pretty stupid. But the rails themselves are first principles correct. And that's really like, to me, what internet capital markets represents is just like the ability to rethink that from first principles. What we see happening now on chain is the ability to like mix and match all kinds of different things together in finance in very clever and actually very efficient ways. In kind of one element of that is like there are systems like Parcel out there, which allow you to speculate on an index of median price per square foot of real estate in a city, say Austin. You can like go long Austin, short New York, or go long Miami, short Atlanta, or whatever. And that's really cool. And that's just like a new economic construction that really is possible only on crypto. And then on the other extreme, you can just like, you can use a derivatives position like on a BTC, for example, perp or even a deliverable forward, and use that as collateral to make a bet on the election or on a sports game. And like traditionally CME was one thing, NYSE and NASDAQ were one thing, DraftKings was another thing. And these were all just completely isolated systems. And yeah, you'd have prime brokerages like JP Morgan or Goldman Sachs try and provide a balance sheet to hedge funds to like make it work. But A, that's by definition one layer of inefficiency, and two, only accessible to like larger players. We now have just embedded all of that risk in software, and it's kind of like the purest form of like what is risk management, and it's just straight embedded in software. And to me, that just kind of represents like the logical endpoint of finance.
To drill down there, Kyle, if you look at things like tokenizing stocks on chain, does liquidity become an obstacle? Because I think as far as 24/7 trading, we know that traditional financial markets are kind of moving in that direction anyways. And so it strikes me that maybe Solana needs something else that it offers. And one potential hurdle is that if these assets are natively issued on traditional financial markets, they'll be more liquid there than the tokenized version that then trades on Solana. So does that become an issue, and how do you kind of rectify that?
Yeah, Tuli and I and a bunch of others have been spending a lot of time recently trying to figure out how do we get regulated TradFi assets on chain. And there's kind of like, I think a couple of things that stand out to me. One kind of issuer side and then one holder side. On the issuer side, I think the main reason to issue on chain today is getting access to a different group of people than you would otherwise be able to get access to. There's, I think, a handful of companies out there that probably want their customers, like the most obvious example here would be Phantom. Their customers are all by definition using crypto on chain. If you really want to go long Phantom, you can't, even if you love the product, love the business, love the service. And so like a company like Phantom makes a ton of sense to IPO on chain, just given the inherent nature of their business. I think they could probably expand their holder base versus IPOing on like NASDAQ or NYSE. The other thing I've been thinking about that's a really strong drive to tokenize is to get more interest on securities. Robinhood does this today. If you own Apple stock or Tesla or whatever on Robinhood, you will get paid some amount of interest. But then Robinhood's going to take some of that interest as well when they lend it out to market makers or whatever. But on systems like Camino or Drift today on Solana, you can post, if you had Apple stock or Tesla stock, you could post those as collateral, and you can just take, there's no margin. You can get 100% of that yield. And so I think there's a real draw for long-term holders of assets to actually want to deposit them on chain so they can earn higher yield in that native asset.
Now for a quick word from today's sponsor. Celebrating 10 years of innovation, Ledger remains the most secure hardware wallet for your Solana and logins, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a robust ecosystem of products and services, making digital ownership more secure and accessible to everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, feature the world's first secure touchscreens, making it easier and safer to manage your Solana transactions and coins. With Ledger Live, you can seamlessly and securely manage and stake your SOL. Alongside Ledger Stacks and Ledger Flex, Ledger introduced the Ledger Security Key app, a safer alternative to traditional passwords, enhancing your overall digital security. Thank you to Ledger for making today's episode possible.
Totally. Let me turn to you, because when we talk about internet capital markets, I guess, there's this really interesting concept that doesn't exist yet, but has always been sort of a future vision for Solana, which is multiple concurrent leaders. So currently, every 400 milliseconds, Solana has one leader that proposes the block, and they kind of have a monopoly on the block space for that amount of time. But if you have multiple leaders, you can do things like get information that happens in Singapore to trade on it if you're in Singapore, rather than waiting for that information to travel to wherever the stock market is located. So, and you've talked about this. So maybe expand a bit on multiple concurrent leaders at a level that we can all understand, and how does that kind of make these markets function better?
The point of all these decentralized systems is to create like a fair environment where everybody knows the rules and there isn't anybody that has an advantage over all the participants. And when you have a single leader, that leader has a monopoly on what transactions go into a block. And people pay them a priority fee or a tip or something like that, but they can simply reject those tips and decide to only include their own transactions or pick the order. And that allows them to extract, people call this maximally extracted value, but basically extract more value than what is seemed fair or what effectively centralized systems can extract. And ultimately, if you're building a product, you're competing with somebody else. And these decentralized systems have to be cheaper and faster and better for consumers. So effectively, the MEV has to be lower than what centralized providers charge. And my belief has always been the way to ensure this is to maximize competition. So if you have multiple providers for including transactions, they can effectively offer the best rebate, the best landing rate, or whatever features that you want for exclusive access to Phantom users or backpack users or whoever else, or Jupiter. So if you have a market, then the applications that care about their user experience, the wallets that care about their user experience, and the fees their users pay will route their transactions to the best place or the best validators for execution. And you can kind of get there a couple ways. You can make slots faster, and there's some of this already happening on Solana. Just simply because Solana has 400 millisecond slots, you could wait 1 second for the next block producer. But the best way to do this is by allowing the network to have multiple block producers or leaders at the same time. And the effect that has is really subtle and really cool. I think that when you look at these systems like exchanges or any other trading system, it's reflecting the price of the real world. But there's an error between the data that's in these machines and the actual prices in the real world. And the faster you can move information in and out of these systems, the smaller the error. What's cool is if you have multiple concurrent leaders, you have a block producer in New York, you have a block producer in Singapore and Tokyo. If there's some financial event that happens in Singapore, like a ship full of iPhones sinks for some reason, that information still has to travel to New York before it's traded on NYSE. So that's about 80 milliseconds of data that it has to transmit. That transaction that reflects that event could go directly into the block producer in Singapore immediately in less than 1 millisecond. So by the time that newswire hits New York, that price is already reflected in this decentralized system. It may not be a better price discovery engine than NYSE in its best case, but it's as good. And it's run by volunteers, it's open source software, it's global. And those latter features is what I think will make it inevitable as Linux was versus the closed source operating systems.
Well, one thing I like to add there, people who talk about latency in trading systems typically are referring to the latency of the matching engine, and NYSE and NASDAQ or whatever, measured in nanoseconds or microseconds or whatever it is, very fast. Solana is measured in milliseconds, so we're talking 3 to 5 orders of magnitude faster. But I've kind of come to realize that's not necessarily the right notion of latency to optimize for. Market makers care about that kind of latency because they're fighting over transaction inclusion and being faster than the other guy to get in the system to make money on kind of statistical arbitrages and other very market microstructure kind of things. But the more I've thought about this, the more I've realized the notion of fairness or latency you really want to optimize for is not for market makers, it's for takers. Because takers are ultimately the ones who are actually setting prices on the margin, and that's Joe Schmo or you in this room buying whatever or selling whatever you're going to sell. And by decentralizing the matching engine to operate all over the world, although the global consensus is measured on the order of hundreds of milliseconds, the time it takes for a person to actually express their opinion will be, in the average and the median case, several orders of magnitude faster because takers are by definition all over the world. And if you have nodes, Solana nodes everywhere all over the world, then you're actually improving time to transaction inclusion for all of those people. And so weirdly, decentralization leads to better latency guarantees or transaction guarantees for normal people. and it's at the expense of market makers. There is kind of an inherently inverse relationship between those two things. What market makers want is centralization and determinism, and what users want is quick getting in. And so it's just kind of like a fundamentally new way to rethink like market structure design.
Interesting, yeah. And totally from where we are now, like obviously multiple concurrent leaders is a future vision for the network. How confident are you that that feature would be shipped in, say, 2025?
Say 1%. I'm like,
What's a likely timeline in your view?
25% in 26. That's kind of like, I think there's alignment across all the engineering groups, but like the main focus right now is making sure Firedancer is fully feature complete and is fully live.
Since you mentioned Firedancer, let's go into that a little bit. Firedancer, built by Jump, very performant new client for Solana. People always talked about it in this very mythic way that it would like supercharge Solana and bring it to 1 million transactions per second. But we're now in this weird middle place where it's like live and non-voting mode. So I guess where do things stand with Firedancer, and in the actual like reality world, what will its rollout likely look like for the network?
So their efforts prove out that the protocol without any changes can actually scale just to whatever hardware you throw at it. So if you have a fast network with fast switches, fast network cards, and fast computers, you can just soak up all that bandwidth and do 1 million TPS without any changes to the algorithms and the design of Solana. So that's really, really cool, because then once we know what all the bottlenecks are, the other teams like an Agave can go fix them as well, and the hardware can be fixed as well. So even the network layer itself, there's now a project called 00 to upgrade the switches between data centers to make sure that there's no latency incurred as packets fly through them. And the demo that Firedancer guys did, a breakpoint was on top of effectively 00 that hit 1 million TPS. So there's no like fundamental changes to Solana needed to scale to 1 million TPS. It's literally just crimping RJ45 cables and like putting boxes in the right places. So like that means that, you know, all the really, really hard computer science stuff is done. It's just kind of engineering and rollout. And that's going to be driven by demand, right? If this deployment costs money, you really want to do it when you start seeing demand and kind of scale up with the demand. The really, really core important thing that Firedancer does as well is it's a second implementation. And fundamentally, I think these networks, especially ones that are like worth, you know, hundreds of billions of dollars, they need to guarantee safety. And the way you guarantee safety with these complex software projects is you have to have redundant implementation, so the probability of a bug existing in both is virtually zero. So that's really kind of the big unlock for me for Firedancer is once more than 33% of the network is running Firedancer, you know, bugs that would otherwise be safety catastrophic failures are now liveness failures.
So what would cause, like, say in theory Firedancer comes out, it has the correct MEV modification, so it produces a lot of revenue for validators, it's much more performant. Why would the whole network not switch to Firedancer, and then you have practically nobody running the current Agave client?
One is the network parameters are set such that the slowest client that's considered canonical can run it. And two is Agave keeps getting faster every release. So like we've seen this basically the last 5 releases, the network keeps getting faster and faster. It's not like those engineers are bad or anything like that. They're excellent engineers. They know what to optimize.
Mm-hmm. Yeah, I think that's going to be an interesting thing to watch is Agave, or I guess Anza, put out like a roadmap where they said we want to be the best validator client on Solana. Like they're going to be competing with Firedancer as well. So that'll be fun to see. Maybe Agave becomes better than Firedancer somehow with just all the time that those engineers have had to optimize the code. Kyle, I want to ask you about ETFs. So this room will probably be aware we have Bitcoin ETFs, we have Ether ETFs, and The Ether ETFs, which I guess would be more similar to Solana, were not the most inspiring from an inflows standpoint. And I think one of maybe the big things that held them back was staking rewards. But I guess my question for you is, assuming we see Solana ETFs get approved soon, what do you foresee the demand looking like? And do you think that they can outperform what Ethereum did?
Yeah. So feel pretty good we're going to get some Solana ETFs this year. I think if you look on Polymarket or Kalshi, I think the odds are like in the 90% for 2025. It was publicly disclosed. I was at a meeting with Jito in the SEC's office 4 or 5 weeks ago. So obviously had a chance to speak with those folks. The notes from that meeting are online, actually. The SEC tweeted the notes without telling us. So that was a fun morning to wake up to that. So generally feel pretty good that we're going to get there in the pretty near future. In terms of forecasting demand for SOL ETFs, I'm not in a position to do that based on like having had conversations with lots of institutional investors. I can tell you I've certainly had a lot of calls with the folks at Bitwise, at VanEck. I think they're the two kind of likely to be the two front runners for the Solana ETF when it comes out. And they tell me they're really excited and they think it's going to exceed expectations. I think the big thing that those folks, they've had a learning lesson of the Ethereum ETF, and ETH is a very different asset than Bitcoin. And I think a lot of the reason the ETH ETF didn't have a super strong reception was that a lot of investors looked at ETH and they were like, okay, show me the fees. And the fees on Ethereum today are around to zero. I think ETH is trading at like a 1,000x PE multiple or something like that. Maybe it's 300x, I don't know, somewhere in that range. And so a lot of folks are like this, I'd rather buy Tesla or NVIDIA or, whatever else. I'm going to pay that kind of a growth premium. So I think it just hasn't been very appealing to folks on that basis. Solana today, depending on how you want to measure, whether it's a rolling 1 week or 1 month or 3 month basis, looks like it's trading more, probably a 30x, maybe 50x multiple, depending on how you want to measure it. And so the growth multiple is just much more in line with like traditional high growth tech stuff. And I think that's a lot more digestible for people. So I suspect that will be a pretty meaningful difference. And then I think the other one is, I look at all of the analysts, whether they're JP Morgan, Morgan Stanley, Standard Chartered, whatever, and these guys are all obviously playing with these systems. And, I think it's basically universal agreement at this point that the user experience net on Solana is better than the user experience net all across the Ethereum ecosystem. And I think that, resonates with people. So I suspect that, smaller market cap base to start from, better valuation multiple, and just objectively better product experience, I think will net lead to a lot more success.
I want to talk about staking rewards because there's two schools of thought on this, I guess. One is that Ethereum, say 3 to 4% staking APY that you get for staking the asset with a validator. On Solana, that's more like 8 to 10% currently. And so if we get ETFs approved, but they don't have staking rewards enabled, which is currently the case based on prior SEC approvals, then by buying a Solana ETF, you're maybe, this isn't exactly correct framing, but say you're foregoing 8 to 10% of the yield. Now, others would argue that these are very volatile assets. You're not buying them because you care about this like risk-free rate that Solana is offering, so it won't matter anyways. But do you think that if Solana ETFs are approved and they don't have staking enabled, will that significantly hamper basically the adoption of these things?
I don't think the lack of staking yield is what causes the success or failure of these products. Obviously, if you own the asset, it would be nice to stake it. But I don't think that incremental 8% of nominal return is driving a decision for anybody. I do think we will have, with very high probability, staking ETFs this year, based on conversations with the SEC and a bunch of other folks. And again, you can go look at the meeting minutes from my meeting with the SEC from 4, 5, 6 weeks ago. It's public. I think the other thing I would add on top of that is, I think we get a staking ETF this year, and I think there's a non-zero chance we get a staking ETF for Solana concurrent with the SOL ETF. I don't put that at like a super high probability, but I put that at meaningfully non-zero. The last thing I would say is actually, I think weirdly, this is one where Solana is in a much better position than Ethereum. a lot of the discussion we had with the SEC and the JITO folks at the meeting was around bonding and unbonding periods in the staking mechanisms. In Solana, the bonding and unbonding, meaning to go from standard SOL to staked SOL, is deterministic. There's a maximum amount of time, is 2 days. From the moment you initiate, you click the button and say you either stake or unstake. It could be 1 hour, it could be 1 minute, but you have a guaranteed hard cap of approximately 2 days based on the length of an epoch in Solana. In Ethereum, there is no deterministic guarantees. Ethereum has a bunch of reasons why they implemented what they have, and I won't go into all the reasons, but their system is dynamic. And so there's 120 million ETH in the world today, approximately. If tomorrow 20 million people, if you try and stake 20 million ETH on one button click tomorrow, the system will not stake 20 million ETH. It'll create a queue, and it'll stake, I'm just picking, it's 100,000 ETH per day, or whatever the number is, and then it'll work its way through that queue to stake all of the ETH. And then the same is true in reverse. If you tried to unstake 20 million in one click, you're only going to unstake, again, X per day. And so this is actually a really big problem for ETFs, because if you want to have an ETF, which let's say like is 100% staked, that's really not going to work if you have non-deterministic exiting. And if you want to even go like 90-10, that could still be a problem, because if you have, let's say, have more than a 10% redemption from the ETF during that deterministic queue schedule or non-deterministic queue, you can see how the ETF could end up effectively being underwater. And so this is a really hard problem to deal with. There are ways you can deal with it, but they just get kind of wonky. The Commodities and Exchange Act, the CEA, that regulates commodity ETFs, has some provisions in it that make it even harder to kind of have human discretion on top of these things. And so net on all this stuff, Solana is actually in a very good position here, just because of the core design of the system. It's very amenable to deal with the realities of ETFs.
And it was interesting this morning, JITO put out a report arguing that its liquid staking token, JITO Sol, is not a security. And when you talk about some of the obstacles of creating a staking ETF, liquid staking tokens seem like a pretty elegant solution. So just reading tea leaves, it seems like JITO is maybe positioning itself to have like a JITO Sol ETF or something along those lines.
Yeah, I mean, we went to the meeting with JITO for that reason. Well, I don't know if we're going to get it, but like it's very clear what the objective is.
Mm-hmm. Now for a quick word from today's sponsor. Celebrating 10 years of innovation, Ledger remains the most secure hardware wallet for your Solana and logins, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a robust ecosystem of products and services, making digital ownership more secure and accessible to everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, feature the world's first secure touchscreens, making it easier and safer to manage your Solana transactions and coins. With Ledger Live, you can seamlessly and securely manage and stake your SOL. Alongside Ledger Stacks and Ledger Flex, Ledger introduced the Ledger Security Key app, a safer alternative to traditional passwords, enhancing your overall digital security. Thank you to Ledger for making today's episode possible.
So we've talked about Solana, the asset, the network, but there's also this whole ecosystem of things that have been built on Solana that I want to get into as well. I guess, Toly, I'll start with you. First of all, when are we getting the new Solana phone?
It's soon. It's on track. It's being built. I think we're...
You're going to pull one out of your pocket right now?
Not yet. I'm about to get like a full production device, like I think maybe next week. But it's basically at the tail end of like getting everything ready.
All right, there's your headline. It's coming soon.
Yeah.
As you look, I guess, outside of Solana Mobile, which obviously you work on, what excites you the most in terms of just the whole broad Solana ecosystem and the different things that are being built there?
I think like the most disruptive thing that crypto's built is stablecoins. So very boring stuff, just dollars backed with treasuries. We've seen I think right now, or like the last 5-10 years of stablecoin growth has mostly been as counterpair to Bitcoin. But we're actually starting to see payments and other use cases pop up. And just with my experience when we did the Solana Mobile pre-sale, users self-selected to pay USDC globally. So they had the option to use a credit card, but if you're buying cross-border, credit card purchases, and a lot of times the user gets hit with the exchange fee. But you can use stablecoins everywhere now. And when we turned off credit cards, our sale numbers didn't drop. So it's been really refreshing to see that, for the vast majority of kind of global merchants, you can start using stablecoins and you can probably get your users to switch. We didn't use any incentives and our users are more crypto native, but the yields on stablecoins are so large right now that those incentives should be used to effectively start moving folks off credit card rails to stablecoins.
Interesting. Kyle, I want to bring you in here because you've written about stablecoins and sort of the way you should value payments maybe as a benefit to a blockchain. So speaking of stablecoins and the ability to use them for payments, what's your take there?
Yeah, look, I think if you go, there's 8 billion people on the planet. If you could go to each of those 8 billion people and ask them, hey, you can denominate your wealth in any asset, gold, Apple stock, S&P 500, euros, yen, whatever you want. My suspicion is if you went and asked everyone in the world and they could answer the question without fear of political persecution, I suspect 5 to 7 billion of them would say US dollars. And so it's probably the single largest arbitrage ever in human history is to just get those people what they want. If you think that's what they want, then give it to them. And crypto rails are going to be the mechanism by which you do so. And so I think there's a massive opportunity to get stablecoins in the hands of billions of people. And as you get to more and more scale, more payments, you're going to need a scalable system, like Solana. I think the other kind of part of you kind of alluded to this, and I'm reading between the lines here, but it's well, why is that good for a blockchain, whether it's Ethereum or Tron or Solana? And I think having stablecoins on chain is good for a couple of reasons. One, more people having money on chain means it's easier for them to take subsequent actions. The hardest part of getting into crypto is getting out of TradFi and into crypto. So if you have money on crypto, then much easier to move around from there. And then I think the second is, once you have stablecoins on chain, a natural question is, hey, how do I make some money from those stablecoins? And you can lend. The obvious way to make money from that is to lend it out on services like Camino or Drift on Solana. They both have a few $1 billion each in their respective lending markets. And I'm a customer and investor in both and support them both. But the other thing actually we're seeing happen now that's more interesting is this idea of what are called drift vaults. And these are the ability to basically effectively lend money to market makers. And then the market makers can trade with that money. And they have different strategies, some delta neutral, some directional. But it's actually a really interesting way for people to earn yield on their latent assets. It's, if you were traditionally a random person and you wanted to earn, becoming a market maker requires a amount of scale, operational efficiency, CapEx, and sophistication that 99.9% of people are never going to access. And using crypto rails, you can trivially, effectively lend to market makers. That comes with risk, to be clear, but it's trivial. You can do it. And today there's, I think $400 or $500 million today on Solana being lent to market makers through this mechanism. Other chains have probably an incremental 500 million on top of that. And so, we've got about $1 billion of capital now being lent out in these systems to make markets more efficient. And this to me is just awesome to be able to basically, bridge capital markets in this way.
Okay, so that's stablecoins. Kyle, what's something in the ecosystem that excites you that's maybe a little wackier than just tokenized treasuries?
Yeah, I mean, an area we spend a lot of time on at Multicoin is what's called DePIN, stands for Decentralized Physical Infrastructure Networks. We were very fortunate to kind of back Helium early on, and they're kind of the poster child for DePIN. The idea of DePIN is basically there's a lot of problems in the world that require setting up a lot of infrastructure in many different places. So Helium is, a super quick explainer, wireless network. The idea is, hey, if there's bad cell coverage somewhere, you as a local entrepreneur can set up a wireless hotspot, and anyone walking around nearby can then pay you as the hotspot owner per byte of data for using your local hotspot. It really is capitalism in its purest form applied to wireless networking. And there's a whole bunch of other problems in the world that have the same shape. Mapping, electricity, GPUs, bandwidth markets, there's all kinds of weird problems where you inherently need to have lots of local infrastructure everywhere to make them work. And today there's a really budding ecosystem of DePIN teams applying these ideas to drones, energy, logistics, bandwidth markets, et cetera, around the world. And so we are pretty large investors in DePIN. We've made, gosh, I would say 7 or 8 probably DePIN investments by now, and incremental capital at risk, on the order of 50 to 100 million in that range. So have put a lot of money to work there and want to continue doubling down.
Mm-hmm. So Solana leads among layer 1 blockchains in what we at Blockworks like to call real economic value, REV. It's kind of a measure of tips and fees that users pay to transact on a blockchain. And that's been the case for some time. But the response to that is that most of that demand, or much of that demand, comes from trading meme coins, which are these joke coins that have no real intrinsic value and go to zero over a long time horizon. Totally. I guess, how do you think about meme coins and their dominance on Solana?
Yeah, I think on the surface, just a meme coin on its own is pretty benign. Like, I don't think of it as any different than like a loot box in Candy Crush. It's digital spend that people want to spend. I think the problems arise when people try to manipulate the launches or create a perceived fair market when it's not. And I'm hoping the ecosystem builds better and better tooling to go eliminate those. And that's kind of there's no magic technical solution there. How do you prevent somebody from creating a bad launch? Because there's 40,000 of meme coins launched per day. So whatever systems you create, somebody could literally create a no-name coin, be the solo bid on it, and then 2 weeks later, do the actual launch. So it's going to take a lot of work on the analysis side from you guys, from Bubble Maps, a whole bunch of other ecosystem projects have been working on building better screening tools and things like that. But these are all actually, I think, important problems to solve, because if you have truly open global internet capital markets, a startup in China should be able to launch a token that's value accruing and raise capital from anywhere in the world, right? And vice versa, right? A startup in the US should be able to launch a coin and raise capital from anywhere in the world. How do you make sure that those launches are fair and open is the same problem. You need the tools, you need the analysis, you need the screeners and stuff like that.
But even if these meme coins are a fair launch, they're still at best just gambling.
Yeah, absolutely.
So would that be like disappointing to you, I guess, if on a longer time horizon, nothing more interesting than meme coins becomes the dominant use for Solana?
Yeah, for sure. I mean, we didn't anticipate NFTs or meme coins as being the dominant use cases. We, famously called it blockchain and NASDAQ speed. So my goal has always been, how do we get real world assets on chain? And the first step where we were able to do that was support DePIN projects. So these projects generate real revenue based on usage of hardware that's external to any digital, transfer or whatever. Those are like V0 real world assets that are cash flow, have real world cash flows. We need more of those. And I think eventually you're going to see, the tooling should exist where a company has 50 million ARR can just IPO itself using all standardized open source tooling on Solana and be compliant at a very, very low cost, because all the software is what handles compliance and it's no longer people and processes.
Okay.
I think the other thing I would add is I think meme coins in their current form, which is to say they're very dumb, it's just, a tweet or like an image tied to an asset. I'm fairly confident that will not be the dominant modality that meme coins exist in 5 years from now. There's a lot of people playing around with ideas to iterate on what I'm going to call the format or the product or the asset. No one's cracked the code yet, but there's enough brain power and enough creativity trying to figure out the evolution of what these assets should look like that I'm very optimistic that the majority of meme coins in 5 years will not look like the meme coins being launched today.
So we're running a little short on time, but I want to pose one question to both of you to end on, which is, Solana just celebrated its 5th year since its Genesis block. Congratulations, you guys. Toli, you obviously, launched this chain. Kyle, you were a very early investor. And this week, there's been a lot of stuff on Twitter of just remembering 2020 and what that felt like, and people posting why they passed on investing in Solana and so forth. I just want to ask, when you think about today versus what you expected this thing to look like 5 years ago, how has it been the same? How has reality been the same or different from kind of what you would have expected? Maybe I'll start with Kyle and line with Toli.
We were always on the same page about focusing on trading. I remember vividly in all of our strategy sessions before the network launched, talking about how do we get someone to build a DEX and how do we get someone to trade derivatives. And so, that's been the consistent under-theme, or undercurrent, I should say, over that time. The path to get here has been very circuitous. First NFTs, and then meme coins. But I was just at the tokenized conference yesterday, and it's clear that Wall Street is coming. And as we get stablecoin legislation, which I think we'll get in the next 30 days, and market structure legislation, which I think we're going to get this year, that's just going to unleash tokenization at scale. I mean, Larry Fink goes on TV, every couple months and says tokenization is going to change the world. So he didn't say it once; he said it 6 times now. So I'm pretty optimistic he's going to do it.
Totally.
I don't think we were going to be here in 5 years. So when we launched, it was literally the double black swan when the stock market and Bitcoin tanked 50% during the COVID crash. So I wasn't thinking 5 years ahead. I was thinking 3 months ahead. But I'm very proud of what the ecosystem has achieved and how much they've built, and it feels like it's only growing faster and faster. So I'm really excited about the next 5 years.
Cool. Well, we'll end it there. Toli, Kyle, thank you so much. It's been a great conversation.
Thanks, Jack.